Our next section is on economic growth, measurement, and forecasts. Why is this important for us to understand? First, a company or a firm, you'll hear me use the word firm quite frequently, is the firm is doing business within a broad, it is not a unit unto itself. It's doing business in a broader world. So what happens in the world impacts the company. That's both from a finance perspective and an organizational behavior, management, HR, production. So they're all intertwined, and decisions that are made in either of these fields really are driven by what's going on in the economy, not just currently, but what does it look like going into the future. So in this section, I'm going to walk you through the growth side, which we use the GDP to measure, and then we'll take a look at the labor statistics. So let's get going. A little reminder for everyone is the GDP is a primary indicator of a health of a country's economy. It's not perfect, but hey, it's there. Healthy growing. You want low unemployment, wages increases, businesses demand labor to meet the growing economy. It builds confidence. We feel good in those times. If it's growing too fast, inflation can be a risk. Negative growth, which we have seen and will continue to see for a little bit here, less jobs, less production, and creates negative feels. So that's, I think about it now, you may not be feeling too good about the economy. So that is going to impact your spending. 2/4 of negative growth is a recession. It's a hard line to define when does it become a depression, but we'll learn about that as we go. There's total GDP. It's often expressed as a percent comparison to prior year quarter. How is it growing? Trends are important. It's not a point in time, but a trend. It's complicated, includes other statistics and estimates. It doesn't pick up every piece of the economy. It's not always timely. We're going to take a look at the preliminary first quarter numbers, which is ending March 31st. They came out fairly recently. We'll get the final a week or two when we're into the semester. So just to give you a sense of the size, I want to highlight to you that the GDP total in the U.S. is about, on an annualized basis, $21.5 trillion. Just keep about, say, 21.5, that's trillion dollars. And you can see that it's made up of personal consumption. Okay, that's 14 trillion. So 2/3 of the American economy is by what you and I buy. They break it down into goods and services. And you can tell services is a big piece of what goes into the GDP. Then it's what companies are spending. Okay. Then there's net imports or exports. And then we break it down to exports, imports. And then how much does the government spend? So if we're looking at it, $3.8 trillion, and it breaks down into where the money is spent, you can see that again, that's just about 15-20% of the GDP is by government spending. So that gives you a sense of what makes it up. Key point, about $21.5 trillion. 2/3 of it is consumer. Now, what we have seen is there's a lot of movement with this. I set this graph up from 2003 to current, and you can see there's a lot of volatility. We've had the highest the economy has run since you guys were pretty much alive or as young children is up here when we hit about 7.5% back in 2004, and it moved up and down. This is obviously the Great Recession, and first it dropped. We had a drop below 2, but then it would jump back up as we got a little bounce. Then it went down, 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 down. It took almost a full year to get back to where we were, year and a half. Then it dropped back down in 11, back down here in 12, 14, zero growth in 16, and here, where it had been pretty steady for 3/4, still if we drew a trend line down, and we dropped negative. Okay, in this chart, and you can see as a bar chart that here's the decline in GDP. We saw it in the first quarter go down about 4.5%. Then we saw that that was driven by consumer spending. Consumer spending is what kept it high. As the consumer doesn't spend, the GDP goes down. Net imports, exports stayed about the same, as did government spending. So this gives you a visual of what's happening to see how important the consumer. Now, how are we going to recover? Well, what we're seeing is the use of the alphabet is what you're seeing right now. We have a V-shaped recovery, which means that you have dropped, here's the quarter, and will recover very quickly and get back on trajectory. But this piece in here is lost forever. That's a V-shape happens very quickly. U-shaped, GDP recovers, but slower than the V. So instead of coming up, we're in this lethargic decline for a period of time before it comes back up. These, again, are all lost activity. Okay? These are, people aren't going to make up for this as soon as it's over. Okay? You're not going to make up on trips. You're not going to go out to eat 3 times as much to make up for what you lost. Then there's the swoosh. And that is longer than V, but faster than U. It sort of swooshes up. Then there's Z-shaped, where it goes down, surges back up, and then it drops back down to normal. Then there's the W, and the W is a scary one because just as things look like they're going to get better, they drop down, form the letter U. The other is an L shape where we even move into a long-term, slower recovery. So these are some of the things that people are anticipating. I want to stop now and just give you a sense of the global GDP. And this is pretty accurate. It hasn't changed material. That you can see that the largest component of the worldwide GDP is the U.S. And this gives you a sense of everything else. China is the second biggest, and we can see Germany is fairly large, Japan. India is relatively small. Come back to the number of people. This is the area that is growing, okay? This area, okay? And here is growing. So if we look at what economists are saying, and this time I have decided to use the IMS, International Monetary Fund, and they're suggesting that in 2019, last year, the world economy grew at 2.9%. For 20, they're assuming for the full year a 3% decline. Now that's based on a recovery happening in the third and the fourth quarter. Okay, so that's almost looking, if we go back, that's looking towards that V-shaped recovery. For 28, they're showing a recovery. But look at what it is in the U.S. 2.3 last year, 5.9%, 4.7 going forward. Europe is in bad shape. So is Latin America and the Caribbean. Take a look at emerging and developing Asia. They had been growing at 5.5%. Now, instead of going net backwards, they're still going to be growing at 1, but 5.9 developing Asia. So what we're doing is we're seeing emerging and developing Asia moving the fastest of anybody, followed by sub-Saharan Africa, and then into the Middle East and Central Asia, and then Latin America, then the US, and then Europe. So we're seeing these are pretty optimistic at this point. When you look at the contribution to worldwide growth, and this isn't updated for the 20 estimates, you can see that most of the growth in the global GDP was right here from China. GDP in current terms, if it continues at the same pace, what we'll see is that the US and China, by the year 2050, which is only 30 years from now, China and India will be significantly bigger than the United States. Long-term trends again. Some things that relate to economic growth, people are spending less. This is a survey that says 51% of people are spending less. About the same, 28, but spending more, yeah, you got people spending more, but this is a big number. This increased substantially, okay? And the same thing happened in the Great Recession. But look what happened down here. They not only say what they're going to spend, they have. And we see consumer spending off through, this dated here is as of April 30th, so pretty current, that consumers have spent, they're down 7.5%. They're spending less. And you go back and see what makes up the GDP, you're going to find that's what it is. A few other things, and I'm throwing these out there just to get you a sense of what's going on, because the business is evaluating all of these. This is the ISM, and as you can see, it has dropped. This is the overall composite index, and you can see it was at 41.8, took a precipitous drop. Not as low yet as we have seen in the Great Recession, but pretty low. But here's the part that as a company and as the nation recovers, here's the new orders. New orders are lower than what we had in 2008 at about the same time. That means that if a company does want to open back up, they can, if that's permitted by local and state governments, but there's not any orders for them to make. So if there's no orders, there's nothing for the workers to do. Keep an eye on that, okay? Other things. We've all heard about the airlines. This graph really blew me away, is that this is the TSA checkpoints, and it went from 2.2 million people a day almost to nothing. U.S. airlines are averaging just 17 passengers per flight, 29 passengers per international flight. Can you imagine flying to Europe with only 29 passengers on a plane for 300? I mean, we each could have 3 or 4 rows. I had a real cheap flight to London one year, and it was almost empty in the back of the plane. And I laid out in those seats that are 4, if you're 2, 4, 2, or 3, 4, 4, or 2, 4, 3, I just laid down in the 4, strapped myself in and slept. But you don't make money when you're only flying 17 and 29 passengers. Industry is burning more than $10 billion a month in cash. Most of the world's aircraft are now grounded. They're not flying. U.S. travel has dropped over 90%. You don't want to get sick. There's travel restrictions, but a lot of it is when business isn't running. But this fear, this contagion, is what's going to hurt the industry for a long time. This is not going to recover quickly. It's going to take years. When we had 9/11, it took almost 3 years for the airlines to return to pre-9/11. And that was purely out of, a lot of that was the economy slowed, but also out of fear of flying. And I think the contagion can be a real issue. Delta Airlines, one of the biggest, has 14,000, this just came out today, pilots on its roster, and they expect to have 7,000 more than they need by the fall. Think about what that means. That was reported by Reuters. Billions of dollars in losses around the world. About 70% of renters paid nearly all their rent in April. That means 30% didn't. So landlords are not getting that money But they in turn still have to make the mortgage payment, they got to maintain the properties, they got to pay property tax, insurance, so there's a squeeze here. Barely half the renters said they would be able to pay the May rent. And this all comes together in what is happening with consumer confidence. And this is the first time I've introduced anything about the stock market, but this is the S&P index, and this is the consumer confidence. Consumer confidence is at its lowest level in 50 years. Okay? Now, the market is forward-looking, so they are looking at what might be, and a lot of the market is looking favorably that things will return more as a V-shaped. I don't think the data supports that, but we don't have confident consumers. Confident consumers don't spend money, and since the 2/3 of the U.S. economy is driven by consumer spending, a reduction in that drags the whole economy down. If people aren't buying, you don't need to manufacture things. So there becomes this long-term effect. This is sort of going in a couple different directions here. The consumer price index for all urban consumers declined 0.8. That's good. This is the lowest. Prices are going down. Yeah. On the producer side, they're down even more, implying that we could be in for lower prices, deflation. However, on the other side, and this is reported by the Washington Post, and it's based on U.S. Bureau of Labor Statistics, that consumers paid the price of groceries, okay, home consumption, had their biggest increase in nearly 50 years. Okay, rising prices for meat and eggs. They paid 4.3% more. So now think about this. Overall, consumers paid 2.6% more in April for groceries, the largest jump through since February 1974. And it came out at a time when more than 20 million Americans lost their jobs. So start putting some of these pieces together, driving 1 in 5 households into food insecurity. 1 in 5. Caution, though, on using GDP. There's many different measures you could use. I don't think it always captures the positive impact of technology, improvement in the lifestyle of the population. So there's other things that we might be able to use. We need to be careful of forecasting and nowcasting. More information and the ability to measure economic growth in real time and crowdsourcing information is changing our understanding and use of information. If I set to do this the day you listen to it, and we did it at the same time in live, I would learn new things. New things would come out. So that's not always the best way. So that's our piece on the GDP. The next piece is going to look at the labor.